Hi everyone. Hope you can all hear me and see me okay. Slight teething problem with YouTube there. It seems to struggle a bit when I schedule a stream. It wouldn't let me connect to the same stream that I'd scheduled to actually start the stream. So I hope that everyone found their way to the correct stream. Um, but I wanted to wait a tiny bit and give people a bit of time just in case they're in the wrong one. But we're here now, and of course, it will be recorded and up on YouTube pretty much straight away afterwards. One of the advantages of using YouTube. So hopefully, anyone who misses it will be able to find it pretty quickly afterwards. I'm going to dive straight in. There's a lot going on today actually in the markets. Today is pretty much central banking day. So the Fed are probably talking as I'm speaking at the moment. About their interest rates. The latest interest rate decision for September. The next one will be in November. So yeah, there's quite a bit going on at the moment. So I'll try not to hang around too much for in case anyone else is interested in those things as well. Before I start, the usual disclaimers apply as always. None of this constitutes financial advice. I don't know your specific circumstances, so I cannot advise you on that. All of this is really for marketing purposes only and educational purposes and should not be taken as investment advice. Anything I say is not a reflection of eToro's opinions or anything like that. They are all, of course, just my own opinions. So please bear that in mind as go through the presentation. Okay. So we'll use the same format as usual. A quick introduction to myself for anyone who hasn't watched one of these before. I'm sure there are probably some new copiers as well, or perhaps some that just haven't watched these in the past and are wondering what's going on, so they want an update. So yeah, a quick introduction. I'll go through my strategy a bit, really just the kind of top level way that I kind of go about building my portfolio, my goals for the portfolio, and that sort of thing, how I find stocks and vet them and all the rest. Then we go into performance for the portfolio versus benchmarks for the quarter, for the year to date, and for the trailing 12 months, and looking at the markets related to that. Then we'll take a look at some market highlights, things that have happened during the quarter, and then some trading highlights or portfolio highlights, I guess you could say, and how things have unfolded and what's been impacting our portfolio during the quarter. And then at the end, we'll round it out with a brief kind of look at some of the key things that I'm still keeping an eye on for the next few months ahead. And then at the end, there'll be some time for question and answer if anyone has any questions. So if you do, then yeah, try and leave them until the end if you can. That way it's a bit easier rather than me stopping and starting throughout the presentation or anything like that. Okay, so this slide again, I'm sure everyone's getting very familiar with it at this point. So I'm Jay. I've been trading now for what feels like, honestly, most of my life. It probably is most of my life, even at this point. It's certainly getting close to that. I've been trading for a pretty long time now. I'm almost at 10 full years on eToro, so that's pretty exciting. And about half of that as a popular investor on eToro, just over half. So I've been doing this for a long time now, used to the pressure and the ups and downs of the markets and everything else. Originally, I was self-taught, been really on a bit of a journey through my investing kind of career, I guess you could say. I self-taught myself everything at the start, was always really fascinated by markets and the economy and business generally. And really that kind of is what got me into investing. So I started investing on my own with my own money. eToro was not the first platform that I started using, but it wasn't too long before I moved to eToro. So the stats that you see on eToro are a pretty good reflection of my full trading history. It's just missing a couple of years before it. Since joining eToro, I've got a compound annual growth rate of over 30%. I'll give you the exact number on the next screen. I calculate it every time I make one of these presentations manually just to make sure that it's fully up to date. I also pride myself on my kind of ethical approach to investing. And I like to kind of see myself as a bit of a forward thinker and a futurist, always trying to look at what future trends there'll be, and that's really the kind of the core theme of the portfolio is that I'm trying to invest in disruptive technologies and businesses that are really kind of mixing things up and are likely to be the long term kind of future for the world. Providing, of course, that they sit within a somewhat ethical framework. If it's a company that's using humans as batteries, then maybe not. Not that I know of any companies doing that, but you never know. My background before doing this is actually in gaming and events. So I worked in the gaming industry for several years. I was a professional gamer for some time. Then I moved into gaming events, doing event management, some logistics in there, and then esports management as well. So pretty strange kind of career path. I ended up quitting that in 2017 to go full-time as a popular investor. I actually started as a popular investor in 2016, I think, if memory serves correctly. So a long time working as a popular investor on eToro. And as you can see there, hopefully I can, for the next update or maybe the one after that, I can put a new picture on there from the next popular investor meetup, which is going to be in Abu Dhabi this year. Maybe I can have a different picture for you, and maybe at least I can update them once a year or something, because I think they're getting a bit stale. At least for me. Maybe it's just me because I see them all the time. So some track records and track record metrics for you. So my actual CAGR on eToro is 31.63%. There's obviously some more decimals after that, but that's the gist of it. My assets under copy at the end of Q2 was still in excess of $70 million, over 17,500 copiers. Lifetime return on eToro, this should be stated, on eToro is 1,361%, which I think over 9.5 years is still pretty good. I'm still pretty happy with that. Again, I think there aren't really too many investors that manage to get higher than 20% compound annual growth rate for anything longer than for any investors that have been around for more than 10 years. So really, that's kind of like the bottom end of my benchmark is to be above 20%, but realistically, I want to be about 30%. So the last year and this year being a bit slower as well has kind of brought that CAGR down a bit, but I'm still hopeful that I can maintain a high CAGR going forward. I'm really, really confident in some of the companies that I'm invested in, but I'll talk about that a bit later as well. Okay, so about my strategy and my approach, I feel like I'm probably going to need to update this slide a little bit at some point soon, actually, because I think some of the ESG and socially responsible investing stuff I've kind of evolved on a little bit, but it's still broadly the same process as it has been ever since I started. So really, it's about identifying future trends. At the moment, the future trends that I'm looking at, for example, would be things like food security, I think is going to be a big issue soon. And so I'm trying to look at investing in companies in that kind of area. Smart homes, AI is obviously the big one that everyone's super excited about at the moment. So those are the kind of things that I look at as future trends that I try to identify. Once I've identified future trends, I then kind of delve into various different companies within that kind of sector and start breaking them down. I'm very product orientated, so I like to spend a lot of time researching the actual products that these companies are putting out, sometimes testing them myself, certainly reading a lot about them, learning how installers might or the end user would use them, the types of clients that are using them, all of that sort of thing. I look at the fundamentals of the company, so the actual financial fundamentals behind it, so the balance sheet, looking through their cash flow statement, earnings, listening to the earnings calls as well, which I kind of include in that as well. So there's quite a lot of just filtering through based on the financials of the company that I do to make sure that they are still kind of fitting what the criteria that I believe will make a good return on investment for everyone. Next up is ESG. So ESG, I think, recently has almost become like a dirty word. There's a lot of debate around, and I think a lot of misinformation as well, partially because there's been some greenwashing. There have been some kind of misunderstandings about what ESG itself actually was when it started. So ESG is really a risk framework more than anything else. And it's not just ESG that I look at as well. So I do look at ESG scores, but I also look beyond that at more kind of sentimental stuff and check for greenwashing and really looking at the ethics of the company and trying to make sure that any investment that I'm putting money behind is something that is on the whole good for society and not bad for society. So really trying to avoid things like pollution, environmental damage, companies that take advantage of their workers or their customers, products that are damaging for the world, or just generally bad for people. So things like tobacco, for example, would not make it through my filtering process. Next up, portfolio fit. So this really is essentially about making sure that whatever stocks are kind of left by this point through the process, that they are still companies that really fit with the rest of the portfolio in terms of their correlation more than anything else. So making sure that we are not overly exposed to one sector specifically. At the same time, I don't want to be over diversified either. So you'll notice that I do often have lots of companies in the same kind of area to help diversify risk a little bit, but they're all giving me exposure to the same theme. Whereas there are some parts of the economy where I really don't have very much exposure to. And that's a purposeful choice. So I believe that I can, generally speaking, pick the sectors that are going to do well better than the market, I guess. Otherwise, I wouldn't be doing this job. Sentiment. So sentiment really is a much smaller part of the process. Both of these last two are a smaller part of the process, but essentially this is looking at really everything from general kind of public opinion. It could be as simple as overhearing other people's opinions on companies or asking people in a specific industry what they think of a company that I'm investing in that sector. Or it can be something a bit deeper than that and looking at the amount of following and tweets and mentions there are on social media and the followings that these businesses have got as well, and how they're able to potentially leverage that to increase sales or get more leads and things like that. And then lastly, there is technical analysis. Again, this one's not quite so important for me. I know a lot of people put a lot of their time on technical analysis, but I prefer fundamental analysis, generally speaking. But that doesn't mean that TA doesn't have its place in part of the process of deciding when to enter and exit positions. And I see it as another tool in the kind of workshop really to help me figure out if something is a good investment and if the timing is right for that investment or not. So going into Q2, the themes that I was kind of working on, and again, this is very loose. There are more themes in the portfolio than this, and you can break them down into smaller chunks. And there are some chunks that I don't necessarily cover in this, but generally speaking, these are some of the core themes that are in the portfolio. Some of them are quite broad, like technology and software, for example. But I try to give a kind of broad overview of what the portfolio is giving you exposure to when we went into Q2. So this obviously would have been back in April kind of time. So fintech is the first section. This is actually a relatively small part of the portfolio, but it is something that I specifically found quite a few companies in that I really liked. Some of them aren't so much fintech as just fin. So for example, Visa is part of the portfolio, which I think a lot of people see as a pretty boring company and one that maybe doesn't have that much growth, but actually it's been growing at, I think, from memory, around 25%. year on year on average for the past decade or so, which is quite staggering, really, because a lot of people think that it's a really established business and there's not too much growth left, but they're still doing really well. Obviously, in the picture, you can see a lot of the kind of services and things offered by SoFi, which is another company in the portfolio that fits in this segment. StoneCo is another one that I'll talk about a bit later. I generally have exposure to this sector most of the time in some small form, and yeah, at the moment, this is something that's something that I wanted to highlight. Semiconductors is next up. So you can see pictured some of NVIDIA's hardware, which I'm sure everyone under the sun is talking about. NVIDIA was actually one of the first stocks I ever traded back in the day. In fact, thinking back to my first ever investments that I ever made, I'm pretty sure that it was ARM, which has just gone public again this year, but it used to be public before and was listed on the London Stock Exchange. So ARM Holdings, Activision Blizzard, which was of course acquired by Microsoft earlier this year, and NVIDIA was another one that I invested in very early. So really, it's kind of come full circle over 10 years of investing, and I'm still investing in the same companies, and they're now the companies that everyone in the world is talking about, which is really quite interesting, and just goes to show that sometimes you can be earlier than you think to a trend. Or maybe I just had no idea of how much more was coming from those companies, or perhaps the truth is somewhere in the middle. Renewables, obviously this has been a big theme in the portfolio for a long time. Obviously a pretty hot topic at the moment because the solar companies in particular are doing a really, really bad, having an awful year. And that's really held our portfolio back for the first half of this year. And if I'm being honest, spoiler alert, it's probably not going to improve that dramatically in the second quarter, in the second half of the year. But going into 2024, I'm still very hopeful that these companies will do well, and have done a lot of research into it. And really, I'm very, very bullish. Technology and software, it's impossible to try. It's like you try and categorize this and break it down into subcategories, and it's an incredibly difficult thing to do. So in the picture, you can see CrowdStrike. That's one of the newer positions that I've added, and it's made its way into the top 10 positions in the portfolio. So cybersecurity company that does endpoint cybersecurity. So yeah, I'm really bullish on them at the moment. There's actually some other companies in the space that I was tempted by as well, like Zscaler, for example. But I settled on CrowdStrike in the end. But this category covers everything from Microsoft, Sony, and the big guys like that, and Google and the like, down to much smaller, kind of more niche companies as well. Electrification is another massive trend, ties in very closely with semiconductors and renewables and technology and software. But generally, a lot of these companies are quite hardware focused. They also offer quite a bit of exposure to automation trends and some of the other kind of more industrial, large-scale use cases as well. Generally, these are seen as pretty slow and stable companies, but some of them have performed incredibly well over the past few years. And actually, I think are a big part of why the portfolio has managed to stay afloat this year, despite how poorly some of the big solar positions I had were doing. So yeah, really, really happy with how my investments in that space have been going. And then last of all, we have consumer discretionary. Most of the stuff that I invest in here is actually direct-to-consumer style products. So things like Lovesac, for example, would be a good example of that. But there's also, much, much bigger companies like, for example, Mercado Libre, pictured here, which are essentially the South American version of Amazon. Moving on to some of the performance numbers for the quarter. So for Q2 2023, you can see the number there at the top of the screen, 1.28%, which doesn't sound too impressive, especially when you compare it to the S&P 500 and the NASDAQ. But I'll talk about that in a little bit. First of all, I wanted to compare it with the European numbers. So the top numbers there are adjusted for US dollars. The bottom numbers are actually in local currencies. I used to have it the other way around, and I realized that was stupid. And, I want to highlight the thing that is the most consistent measurement. So US dollars is what I measure everything in. Honestly, even when I go and buy things from the shops, I tend to think in US dollars quite often. So the FTSE, is really the only one there that I've technically beaten. But we'll delve into that in a while. What's interesting is that although it looks on the surface like the European stocks underperformed the US stocks, really there was a big trend going on with AI and the Magnificent Seven, as they're known, which is Apple, Amazon, Google, Microsoft, Tesla, Nvidia, and Meta. So those companies, the seven of them combined, are known as the Magnificent Seven now. So essentially, they've replaced FANG. Netflix got dropped because they weren't doing well enough, I guess. But those seven companies alone are responsible for around 70% of the return for the S&P 500. So if you take 70% of that 8.17% and take it away, you're left with something closer to 2% or 2.5%, which is actually what the S&P would have returned if it didn't have those seven companies within it. Something similar is true for the Nasdaq. In fact, it's even worse with the Nasdaq because they are an even larger proportion of the index. In fact, so much so that in July this year, they actually rebalanced the Nasdaq and changed how they balance the Nasdaq in terms of weightings, because those seven companies were worth at some points in excess of 55% of the entire weighting. So essentially, if you didn't have those seven companies, your performance would be completely different. And I think actually at the time they did the rebalancing, the Nasdaq would have been only, I think, 5% up at the time, and the S&P 500 would have been negative at that time if you didn't include those seven companies. So that's like a really kind of interesting little snippet to kind of include, I guess. So generally speaking, although things look bad on the surface, I think the lesson here is that I did still underperform what was expected, and I'll talk about that separately soon, but not by as much as it may look when you first kind of look at these numbers on the screen. Because really, I think any investment manager or fund manager or individual who wasn't just investing in the index is relatively unlikely to own all seven of those companies, and thus would have done worse than the markets. So moving on to year-to-date returns. So this isn't quite so bad compared to the last slide. If you kind of see it moving across. So the last slide, I was essentially, at, let's say, 10 to 20% of where the benchmarks that I would usually measure myself, being the S&P 500 and the Nasdaq. If we move to year to date, you can see that I'm actually at around 50% or so, 40 to 50%. So still underperforming, but not by as much. So really, I think this kind of reflects that actually not very much happened in Q2. There really wasn't that much opportunity to make money there. There were some big blowout earnings by Nvidia and a couple of other companies that really kind of carried those indices forward. But generally speaking, the markets were actually really very flat for Q2. So there wasn't too much opportunity there, but in Q1 we did better, and so year to date we weren't actually quite so far behind. And then finally we got trailing 12 months, and again here you can see the picture improves even more. So really it goes to show that a lot can change in a few quarters, right? I was basically more or less in line with them with the benchmarks last year. The year before that, I was ahead of them. This year, I am lagging them at the moment. But really, I think, again, when I talk about solar and things later on, I can kind of explain some of that and why that happens. But there's always going to be a bit of an ebb and flow when you're in a portfolio that isn't too correlated with the underlying benchmarks that I'm using to benchmark myself against. But yeah, overall, trailing 12 months, in 12 months, I don't think this is too bad of a return, to be honest, especially given how much there has been going on in the markets in terms of interest rates and recessions and wars and things that people have had to kind of adjust to and navigate. So I'm actually, it may seem a bit weird, and perhaps you're almost even frustrated by it, but I'm actually really not too upset about this performance, because I just see this as, a bit of volatility in essentially what is really a 5, 10, 15-year time horizon. And I think that when I look back at the companies that I've been investing in historically and that I'm invested in now, and I look at where I think those companies will be in 5 years' time, I really have no doubts that there are already companies in my portfolio that will be potentially part of that magnificent seven, in the same way that Tesla and Nvidia are now part of that kind of group. So looking at the kind of market highlights, some of the big events. I will answer your questions, by the way. I can see you all chatting away. I will get around to answering them once I get to the end of the presentation, so don't worry. Please hang around if you want to hear the answers. Even the mean questions, I promise. So first of all, energy markets. Obviously, in Q4 and Q1, we saw massive ramp up in oil and gas prices due to the conflict in Ukraine, and the ripple effects of that across the economy were substantial. It's a big part of the reason why we have as much inflation as we do, especially in Europe. But those prices have since kind of fallen back quite dramatically. Now we're seeing OPEC and co starting to try and essentially limit supply a bit more, so that they can keep the price a bit more stable and stop it from falling further. And maybe that will continue going forward, but we'll have to wait and see. But either way, this was obviously a big kind of trend to be aware of in the markets that's made a significant impact on various different companies. Activision Blizzard's deal with Microsoft. So I guess this probably for a lot of people won't seem like it's that big of an important thing. It may not be the sixth most important in the top 6 most important things that happened in the markets, but for my portfolio it was. And I think also people that don't think it was a big deal perhaps don't understand the impact of it as much necessarily. So I think this is probably the biggest deal in the history of gaming, and is likely to lead to some very, very substantial changes in the gaming industry, and a lot of pressure on companies like Sony and Nintendo and how they act going forwards. Actually, some information has just leaked in the past few days about Microsoft's plans potentially around this and what their thinking was. And yeah, it's I think that kind of reinforces that those guys are really thinking about how best to kind of become the leader in the gaming industry. So obviously that deal getting closer to going through was a really, really important step, and it's actually only the UK now that is blocking the deal from going ahead. Microsoft's in the process of appealing that at the moment. The Magnificent Seven carrying the Nasdaq higher. It's not just me. Jim Cramer said it as well. So I don't think Jim Cramer is necessarily the best person to put there if I want to sway everyone to my side, because Jim has a bit of a tendency of calling things very inaccurately, to the point where there's actually some market ETFs that you can buy into that do the opposite of whatever he does, and actually make quite a good profit, which is quite amusing. But he is correct to highlight this. This is just an objective fact that those companies there are responsible for a massive amount of the returns seen on the markets this year. As mentioned, inflation, of course, is the elephant in the room. That is still kind of lingering. We're getting to a point where it's starting to slow down on the rate hikes. How many rate hikes are left in various countries is, still being debated. Maybe it's 1, maybe it's 3, maybe it's none. But realistically, I think we are close to the end of the rate hiking cycle in most countries, and probably the US is the one furthest along out of the major countries, at least in terms of that. That obviously has some massive inflation implications for the markets, because if those interest rates stay flat for a while, eventually the market can kind of adjust to that, and bonds and loans and everything adjust to that, and the bond market yield curve will start to change its shape to be a bit more healthy. and then businesses can borrow a bit more easily and reinvest in the businesses. So it's a really important thing that this is kind of stabilizing. Really, the question now is, how smooth the route down is. But again, as I keep saying, I feel like in this presentation more so than normal, I'll talk about that shortly. The AI rally has continued. So again, this kind of ties in with the stuff with NVIDIA. Really, the demand is through the roof. If you actually look at the amount that they raised their earnings by compared to before this year started, it really is quite staggering, just the amount of demand that NVIDIA has now got. Obviously, it's not just NVIDIA. There are other people that are benefiting from this. A lot of the companies that provide the actual a lot of the other kind of cloud infrastructure, whether that be switching stuff or even basic things like network cables and things. All of those are going to have a big impact. There's obviously the software side of it, the actual AI side of it, rather than the hardware side. NVIDIA makes the hardware, but it's really companies like Microsoft and Google and Apple and the like who are most likely to benefit from the long-term kind of software implications. And then beyond that, you can actually look out to the companies who would actually be the clients, I guess, of Microsoft and Google and such, who would actually benefit from that. So it could be anything from a company that makes, hard drives or Coca-Cola or anything like that will end up finding efficiencies by utilizing AI in various parts of their businesses. So AI is 100% a really big deal. At the same time, I think there is a bit of potential overhype with AI at the moment, in that realistically, on the software side at least, we're yet to see very many people monetize it successfully. Not to mention some potential legal ramifications in various areas. So, for example, some of the image generation stuff, where models are trained on other people's data and other people's artwork that they've created, for example. There's questions about, who really owns that artwork. Should those original artists be compensated if their work was used to train the AI? So yeah, there's all sorts of kind of things to really think about in this space, and as such, there's various risks depending on where you are existing within that market. NVIDIA obviously is one of the safer bets, but there are plenty more areas within and surrounding AI that I think are going to be good places to be investing in. And then last of all, European markets outperform. So this may seem a bit counterintuitive in some ways when you're looking at the numbers that I presented earlier. But I think that when you actually look at the kind of companies that make up the indices that are used, so the Stocks 50, the DAX 30, the CAC 40, all of these businesses in Europe tend to be a bit more kind of legacy, less tech orientated companies that have a much slower kind of growth trajectory. They're much more mature businesses. A lot of them are industrials. And when you look at the returns that they've made when adjusted for that risk difference and the premium that you'll pay for growth compared to what you're paying for those kind of businesses, it's actually outperformed quite substantially. And this is, it may again seem a bit counterintuitive, because in raw percentage terms, you may look at my portfolio returns and think, wow, you've not produced as much growth, Jay. Why are you so gleeful about what's going on? But when you look at where the returns in my portfolio have come from, and the risk associated with it, it's actually less so than the risk that you would have investing in the NASDAQ, for example. Even just in terms of a volatility basis and just looking at it from correlation kind of side of things. So something to consider there. And I think part of the reason for that, of course, is that a lot of those companies ended up doing well out of what was going on in Ukraine. But also, I think the lag in interest rate hikes in the EU compared with the US is also something worth kind of calling out as being interesting. So some portfolio highlights. There is one on here that isn't on here that I'm going to talk about as well, which is solar. but I wanted to put some positive things on the screen because I'm sure that everyone. I've talked about the solar quite extensively, so I didn't really think it was necessary to highlight it too much. But first of all, fintech still rallying. So some of my fintech positions did incredibly well. As you can see there, I did put some approximate percentages on the screen for how well they did do. So SoFi and StoneCo both up by around 35% in the quarter, which is really, really high, incredible. Both relatively small positions in the portfolio, but still very important to call out. Intuit, it says they're 3%, but what's important is that just after this quarter is when they actually released their earnings, and they soared after that, and I think increased by something around 30% as well. Off the top of my head, don't hold me to it. So yeah, all of those companies have been doing really well. It's not just the fintechs, it's also just legacy financial companies that have done well as well. Not all of them, of course, because we can't forget that there was a big banking crisis and Silicon Valley Bank went under in Q2 right at the very start of it. So, there's been a bit of turmoil in the markets, but unsurprisingly, when interest rates are going up, a lot of these businesses are doing well. So, yeah, pretty happy with the performance from that part of my portfolio. I mentioned AI obviously quite a bit already, but just to kind of reiterate, so talking about the software side of it first, I've tried to increase exposure to some of the companies that I think are most likely to benefit from that and are in leading positions. I have a small position in Amazon and Google. Really, that's more so as a hedge than anything else, to hedge my bets with Microsoft, which is where the majority of my money is with. So Microsoft announced Copilot during Q2, and a lot of different features they're working on for Azure as well, to integrate AI directly into their Azure web services. So I think the potential from that business is vast, completely vast. As far as I can really see, I can't think of any other software implementation of AI that's going to be as productive and as valuable to businesses as this, with the possible exception of one of the other positions here that I added to my portfolio, which was CrowdStrike. So CrowdStrike is a cybersecurity company. CRM is probably Salesforce as pictured as well. Also an honorable mention in that both those companies really are leaders in their fields and both utilize AI a lot in their products already and have done for several years. And I don't really see that changing. Adobe is a weird one. It could end up being disrupted. But where I was talking about some of the legal ramifications earlier, one of the things that's interesting is that their image generation product actually they offer indemnity insurance essentially as standard if you are producing artificially intelligent generated images. What a weird sentence. Very strange sentences talking about these kind of things. It feels like I'm saying words that aren't real, but images generated using their software is actually protected by them from any sort of legal ramifications, apparently. So pretty interesting, I thought, at least. So they're trying to position themselves accordingly. They are being pushed a bit on price as a result because there is more competition now. But I do think that Adobe is still in a really strong kind of position within the market to take advantage of those trends. On the data side, skipping across construction, on the data center side and the hardware side of things, obviously NVIDIA, AMD, Intel, Cisco, Ubiquiti, and I included Eaton here as some of the companies that I have in my portfolio that are kind of exposed to this trend. Eaton is one of the more interesting ones because they generally make electrical hardware, but they also are responsible for a lot of the uninterruptible power supplies and things like that. Some of the battery storage for large data centers to make sure that they stay on when the lights go out and there's grid failure, things like that. And they have been benefiting massively from this trend as well. And it's again, I think highlights what I was talking about earlier, where there's a lot of other companies that people that are not companies that people would really necessarily associate with AI that are actually in the background still earning a lot of money off of this because of the the sheer growth in data centers means that people have to buy more racking, they have to buy more, fans and air conditioning products to make sure that the servers stay cool. They need to invest in their plant property and equipment, essentially, which includes things like battery storage and uninterruptible power supplies produced by companies like Eaton, or switching equipment made by Cisco, etc., etc. Intel also had a blowout earnings just after the quarter as well. So they've been a really good investment as a bit of a hedge. And likewise, AMD has obviously done reasonably well as well. Not as well as NVIDIA, but certainly well enough. And then the last one, which is actually something I tweeted about during the quarter because it's just so baffling to, I think, a lot of people. I tweeted their chart without a label and asked people to guess which investment it was. There were a lot of guesses that it could be a cryptocurrency, some guesses that it was NVIDIA or Microsoft or Google or Apple. All of them were wrong. The chart was actually for a lumber company called Boise Cascade, which I invested in the second half of last year, and since then I think they've I need to double check, but I think they're approaching having doubled during that time period in 1 year. A company that essentially makes various types of wood products and then sells them. So it just goes to show that there are returns to be made elsewhere in the market as well if you know where to look. And obviously, it's really important to see returns coming from other parts of the portfolio aside from just this trend, because we don't want to be overexposed to one trend. Because if it is overhyped, or if there is some big regulations that pass or anything like that, that can kind of undo a lot of the work that we've been kind of pushing for. So I wanted to highlight that. Another company as well that I invested in at the same sort of time was Rockwool. They did have a bit of a hiccup at the start of this year, but they're also up very, very high against where I first invested in them, and also had a good Q2 as well, ahead of the benchmark. So really, really happy with how those investments were going. The last thing that I mentioned I was going to talk about that isn't on this slide is solar. And really, again, it's kind of the elephant in the room. I have written posts about it on eToro already. If you haven't read them, then I'd recommend checking them out. But essentially, the two biggest contributors to the poor performance of my portfolio versus the benchmarks this year are Enphase and SolarEdge, which at the start of the year were, I think, my first and my fourth or fifth largest positions in my portfolio. They're now, I think, third and eighth or third and ninth or something like that. And the reason that they've had such a bad time is partially due to the environment around finance. So obviously, as interest rates go up, generally large solar battery projects and also residential solar and battery projects are often paid for on finance. And if the cost of that finance has gone up, then the return on investment for buying solar goes down. So as a result, they saw a big hit to demand. Price fell down substantially. I think perhaps because of the amount of fantastic performance they've had over the past few years, overlooked that a little bit and underestimated how large of an effect that was going to have on these companies. But we're midway through it now, and I'm so fundamentally bullish on their long-term outlook for these companies. These are the two companies, if I had to bet, that would potentially make it into the top 10 biggest companies in the world in the next decade. So, I'm unwilling to remove them from my portfolio, completely unwilling. Why Enphase over Canadian Solar? Because Canadian Solar make products that are used in solar arrays, in various parts of the solar array, actually. But they don't have the long-term monetization strategy. Whereas what's genius about both Enphase and SolarEdge is that by controlling the inverters, the mod buses, and some of the other things that SolarEdge does as well, and then the battery infrastructure, they're actually building themselves essentially their own power plants on the sly that nobody really seems to have noticed yet, which is quite peculiar. There's a big post I wrote about it about 6 or 7 months ago. I know I said I wouldn't answer questions while while giving the presentation, but I saw it come up and it was relevant. But essentially, they're building what's known as virtual power plants or distributed power plants, which is where essentially they become almost like a middleman utility. And when the grid needs additional power, they can redivert from people's batteries, from their cars, from some of their high power consumption items. So things like, I don't know, freezers or heat pumps or things like that, hot water heating. They can redivert the power that would be spent on that and send it to the grid instead, and then pay the end user who that power has come from for that money, and then give them back the power at a later time. So essentially offsetting when people are using power. And because they are essentially a duopoly on most residential properties and a lot of industrial installations and commercial installations as well, they're in a position where in 5 to 10 years' time, probably closer to 5 years' time, they're likely to be competing with some of the biggest utilities that we currently know of in terms of how much they are contributing to the grid. So yeah, they're essentially making money not just from selling these products into people's houses and from selling services to installers that are installing these products, but they will then be making long-term recurring revenue from people using those products going forward. And so that's why I like them more than the likes of First Solar or Canadian Solar or SunPower or anyone like that. And that's part of why I'm so confident on it. Also, solar is fundamentally the cheapest form of electricity that exists, and that solution that I just mentioned essentially solves the battery problem. Not completely, but it helps solve the battery problem of when people are using power versus when it's needed, and the same for like the geography of where and when it's needed as well. They're helping to decentralize the entire electrical grid infrastructure essentially, and make it more resilient, even more resilient against attacks, terrorism, cyber attacks, all sorts of things. So yeah, overall, super bullish as a result. Again, if you want to know more about it, I've written numerous articles on eToro, kind of covering the topic. So definitely recommend going and reading those if you haven't done so yet. Okay. Almost there. Almost there. So looking ahead for the second half of 2023, I think the first thing, obviously, is looking at inflation and interest rates. Soft landing, as I mentioned here, is now being discussed more and more, as is the dreaded R word for recession. Everyone is trying to bet on when will rate rising come to a kind of a pause or a stop, and when will it reverse and turn into rate cutting. And when that happens, how likely is it that the central banks will be able to balance this in a way that is able to avoid countries from heading into a recession or stagflation or anything else like that. So that really is, I think, the start of that game of trying to guess, how well, or not guess, I guess, but trying to at least kind of get it into a ballpark range of, how well these central banks are going to do at avoiding worst case scenarios and potentially getting the best case scenarios of a soft landing, is really the game that starts in the second half of this year and moving into 2024 more so. So that's obviously going to be something that's super important to watch, and will have a big impact on solar, as I've just mentioned, and not just solar, but any sort of capital intensive upfront cost kind of investments. So infrastructure and projects like that that potentially have 10-year kind of build times before you start seeing a return on investment. Those sorts of things are obviously going to be very reliant on where interest rates are going, and how the economy is doing generally. Solar company earnings. So as I just kind of alluded to, a lot of it will depend on how interest rates and things are going. But with the way that things are looking at the moment, I do expect that they should start to improve soon. and that demand should start to pick back up soon. Obviously, the technology itself is also still evolving. So, panels are still increasing in efficiency, inverters are still getting better, battery technology is still improving. Legislation in different and regulations in different countries are still catching up as well, to make sure that houses are, up to standard and are ready for these kind of things to be installed. California being one of the really big examples with their feed-in tariff system that they have over there, that has been heavily debated and changed numerous times now. Those things can play a really big impact on how solar companies are going to do. And generally speaking, across the board, things are looking like we're through the worst of it now with solar, and that things should start to improve in the second half of this year, but especially in 2024, I think. The last big thing that I kind of wanted to mention was oil and gas, and it kind of actually ties into commodities more broadly, in that, generally speaking, oil and gas are two of the biggest contributors to how much various other commodities cost. I think apart from copper and nickel, maybe a few other things in that kind of area, and some of the other metals, most commodities are down quite substantially this year. And oil and gas is likewise in the same position, which perhaps is why those are down so much, because of the correlation that exists there. But generally, this is going to be something else that's really important to watch through this winter, at least, because of the impact that we saw last winter. People have short memories, and I think a lot of people have almost forgotten how quickly the cost of energy and gas, especially, were increasing, starting at around this time last year. And I was talking about it this time last year when a lot of people weren't. And I think that although it's much less likely to play a big role this year, it's still lurking there in the background and could play a pretty big role on markets, especially given the outsized impact that it has on inflation. So watching oil and gas is important just to make sure that it's not going to kind of postpone the soft landing that we're all hoping for in the economy, and the lowering of interest rates. So that's the third thing that I'm kind of trying to keep an eye on. Obviously, there's plenty of other kind of future trends and different sectors that I'm looking to invest in as well on top of this. But these are really the core things that I think in the next 6 to 9 months are going to be pretty pivotal for making sure that our portfolio continues to perform well, or at least starts to recover some of the underperformance that it's had. And actually, on that topic, that is one last thing that I'll say about the solar thing, because again, I understand the criticism that people have for my underperformance this year, but ultimately, you've got to kind of take the rough with the smooth, right? So, for SolarEdge and Enphase, although they've had really horrible years this year, and not really that great of a year last year even as well. When you look at the top 5 best performing US equities of the past decade and the past 5 years, both SolarEdge and Enphase are in that list of top 5. So they're up there with the likes of Tesla and Nvidia already. So you can see why I have high conviction that, like Tesla and Nvidia, they will also find their way into that top group of the Magnificent Seven, as they're known. Yeah, I just wanted to throw that in as just an extra kind of thing to keep in consideration, that these companies have been some of the best performing stocks of the past decade and the past 5 years especially. And so them having one bad year is entirely acceptable as far as I'm concerned. And if I have to take that and face a bit of a hit and face some harder times and some criticism and whatever else, I'm fine with that, knowing that that their potential for the future is still very, very strong. Okay, we've made it. We've made it to the Q&A. That's all for the presentation. Before I start answering questions, I would first make sure that everyone who is following me on social media, no matter where it is, even on Discord, please be vigilant. There are so many scams and people trying to impersonate me that will try and sell you on some sort of investment scheme that is not real, and try and take your money. So please be vigilant about that. I don't want any more people getting scammed. It's kind of inevitable that some people will, sadly. But yeah, you're here, so all I can do is try to warn you. There's nothing else I can really do to try and stop it. But yeah, if you think it sounds too good to be true, it probably is. So make sure you're following the real me. Generally speaking, my name is Jaynemesis on pretty much everything. So if it's not spelt exactly like that, it's probably not me. And also, generally speaking, as much as you're all probably lovely people, I'm pretty unlikely to just randomly message any of you out of the blue. So keep that in mind. Okay. Before my voice goes completely, I'm going to attempt to answer some of the questions you've got. If you have more questions, feel free to throw them in the chat. I'll start from the top of the chat and go down for the people that asked them right at the start. And yeah, we'll see where we get to. Okay. Is Beyond Meat going to go bankrupt? Oof, that's a good question. Possibly. Let me change the camera so you can see me in all my glory. You don't need to see this presentation anymore, at least. So, okay, is Beyond Meat going bankrupt? I mean, there's a genuine possibility that they are. As strange as it is, because I do think that in terms of the core product, they have the best product on the market. The problem really is execution and cost management within the company. It really is the boring bits of the business that they have got wrong and continue to get wrong. And fundamentally, trying to compete with some of the large food producers was always going to be difficult. The likes of Tyson Foods and things are, giants of the industry. And in a best case scenario for them, they would, even if they weren't able to, rapidly scale up and develop products in house, they would just acquire anyone else that was able to compete with Beyond Meat. And that may end up being Beyond Meat's saving grace, is that perhaps some of the legacy food companies are struggling still to gain a foothold and to gain market share, and they may then look to acquire Beyond Meat. But at the moment, with their accounts looking the way they do and the decreasing sales numbers, it doesn't look fantastic for them. I think bankruptcy is still less likely than remaining solvent and gradually getting a grip on costs and converting it into a profitable company. But it's certainly not something that I'd be looking to invest in at the moment whatsoever. It's just a lot of risk there, really, and especially given the kind of economic environment at the moment as well. It's likely that a lot of people that were quite happy to spend on those kind of foods for maybe environmental kind of concerns or health reasons or whatever it is, maybe no longer have the budget for that, and so that's impacting them negatively as well. So yeah, I'm kind of a bit bearish on them. Not super bearish. I really hope they survive because I like their products, but not something I'd be looking to invest in, even as a kind of I guess a riskier play. Happy to see you're back doing the streams. Awesome, good to hear. When's the big factor in less of the modest returns the past 2 years, war, oil, etc.? What's the big factor in the What's the big factor in less the modest returns? I think I understand what you're asking, but maybe I'm just incapable of reading the sentence for some reason. The words just aren't lining up correctly for me, or maybe you did phrase it slightly differently. But either way, I think the biggest factor really has been inflation. Ultimately, at the end of the day, I am a growth-orientated investor, so I'm always going to do much better in bull markets unless I'm able to kind of get ahead of a bear market. And really, the core kind of thing that fuels growth markets and growth stocks and growth companies is having access to cheap money. If you can have the best idea in the world, but unless you can make it profitable within the first year, in an environment like we're in now, you're not really going to raise money very easily, because people can just get a better return and a much safer return by putting it in their bank. So fundamentally, that I think really is the thing that has made things more difficult for me, is that I lean towards those companies, disruptive companies, innovative companies that perhaps don't even have positive cash flows straight away. And as a result, a lot of the areas that I have expertise in investing in, or where my advantage lies, I've been unable to invest in, or in some cases I have been caught out thinking that they would do better than they were able to do. Whether that be betting on them monetizing sooner, or not needing to raise capital, or whatever it may be. So I think that's really the core kind of thing. Obviously, the inflation and the high interest rates are caused by things like the war in Ukraine and oil and gas, and to some extent COVID policies as well. So you can point the finger at all of these things as being somewhat responsible, but fundamentally, the method in which that kind of impacted the portfolio was through increased interest rates as a result of high inflation. Hey Jay, do you add cryptocurrencies to your portfolio in the future? I don't have any plans to at the moment. Generally speaking, I mean, there are still some cryptocurrencies that I think are doing really well, and that I'm still kind of broadly reasonably bullish on. The problem I have is that when I look at the risk reward in comparison with the other options available to me, I look at the potential for, let's say, Bitcoin or Ethereum to increase by 10 times in value, and then I compare that with a company like StoneCo or SolarEdge or even Microsoft to 10x in value, which sounds ludicrous, over the next 5, even 10 years. And I think that in many cases, those equities that I just listed are more likely to achieve that goal and much less likely to lose me money in me taking that kind of bet that they're going to achieve that. So the risk reward on both sides of it, on both the risk side and the reward side, I find is better in equity markets, generally speaking, than in cryptocurrencies. So it doesn't necessarily mean that all cryptocurrencies are, not worth investing in at all, because there's always, some diversification. And in some cases, I think the upside potential is larger. But generally speaking, I don't think it's worth it for the portfolio at the moment. And also, I am generally a bit more bearish on cryptocurrencies now than I was. I haven't really seen too many real-world applications of cryptocurrency yet. I think that it will still come to the financial market, especially, and the core kind of like rails of finance and stock markets and things like that. Very much on the same page as Yoni from eToro, actually, on that side of things. But I think that it's going to take a while, and I'm not convinced that it's actually that great of an investment compared to what else we could be investing in. So I hope that makes sense. I keep on hearing British instead of bullish. Will Activision shares be absorbed by Microsoft, or will they remain separate? Is it worth investing? Worth the 70 billion for Activision? Yes, definitely worth the money. Really, because it just helps Microsoft with one of their weaknesses. So I think Microsoft have been very, very confident in their ability to deliver a much more kind of cutting edge experience and more streamlined platform for people to game, whether that's through Game Pass and the kind of subscription model for access to various game titles, or whether that's through live streaming games across the internet rather than installing them physically on your computer and things, or through even more simple kind of stuff like the interface and the Xbox hardware or the Windows hardware, software, I guess, as well. I think generally speaking, Microsoft are really confident in those parts of their business. The area that they have struggled the most is to compete with the likes of Sony on exclusive titles. Now, they've given away a lot of their rights to exclusivity, as part of their negotiations with the various market competition authorities around the world. And maybe they'll even have to sacrifice a bit more to convince the UK before the deal finally gets fully across the line. But in reality, the deal is as good as done now, because if every country in the world has said it's okay except the UK, then frankly the UK doesn't really matter that much. If they had to stop selling those games in the UK, they would just do it because it makes sense financially at that point. And the UK would just become like a backwater where nobody gets to play cool games anymore, and I'd have to move. Obviously, that's not going to happen. But yeah, generally speaking, it's been content that has been the big part of the problem for Microsoft. They obviously acquired Bethesda not that long ago to try and alleviate that problem somewhat, but I think they were still quite far behind the relationships that Sony had. So they had to do something. They had to buy someone, and Activision Blizzard, I think, was a pretty sensible target. In many ways, the company already had a bit of a discount on its price because of some of the internal shenanigans going on with upper management and all sorts of accusations and poor treatment of staff and high burn rate for staff and things as well. So as a result, it had a bit of a discount on it anyway, I think. So I think they got a pretty good deal. I think realistically, Activision Blizzard got an okay deal out of it as well. And I owned Activision Blizzard shares in the lead up to the deal because I saw the deal as very likely to go through. So we actually made some good money on that. And yeah, I was very happy about that. Pretty much to me, it was almost like guaranteed money. So yeah, I'm pretty bullish on Microsoft in gaming. I think that they will become the leader in the space over the next 3 to 5 years. May take them another full console cycle before they achieve it fully, but definitely they're on the way there. And I do think that, contrary to what a lot of people say, especially if you look around, Twitter or Reddit and things, I do think it is actually quite healthy for competition, them achieving this, because I think Sony were the ones that were holding back the industry from innovating further and improving the end product for consumers. Not to say that Microsoft won't do that in the future as well, because that's how markets work. It's not a bear market. S&P 500 is quite up year to date. Returns are bad, but it's okay. I trust him. Okay, I appreciate that. Jay is a bull market type of guy. I don't think he adapted his portfolio to the high yield environment. You say that, but I think if you actually look at even eToro's risk profile for my portfolio, not that that's like the most perfect measure in the world or anything, but fundamentally that's based on volatility. And I think it demonstrates that I did try to adjust the portfolio. Ultimately, I just underestimated the impact on some of my really big solar positions, and that's what hurt me. It wasn't just solar positions. I also had some high-risk positions in hydrogen and a few other industries that got eaten alive as well because of the cost of capital increase. But generally, some of my positions in companies like Veolia, for example, and some of the utilities and industrials that I have in my portfolio, they really actually help balance things out quite a bit. So as much as the performance will make it look like I didn't really achieve that much, I think in reality, the beta of my portfolio was higher than the beta of the NASDAQ or the S&P 500 before market started to turn negative last year. And so I did actually manage to avoid a lot of the downside risk, because if you have a higher beta, then that means essentially higher volatility, and that your portfolio should do better when the market's doing well and worse when the market's doing poorly. And I think that I've not done as much worse when the market has been going poorly for me than the kind of counterpart to that of when the market is bullish, me outperforming by a bigger margin. I hope that makes sense. I think I said that terribly, but I think hopefully you will get the gist of that. Okay. Still working through, so if you're typing new questions, please bear with me. What do you think of the BlackRock Bitcoin ETF? I think unless you're very limited in your jurisdiction in terms of how you can get exposure to Bitcoin, or maybe you don't trust yourself enough to look after the Bitcoin, I don't really understand why you'd invest in it through an ETF rather than just directly, because I think the fees on most of those ETFs, I haven't checked them on the BlackRock one or any of the others that are proposed, but I don't really understand why you would invest in it through an ETF rather than just directly, to be honest. Curious to hear your opinion on the spot ETFs, Jay. I mean, yeah, it's great to have them. They will help with liquidity and with exposure to cryptocurrency for larger institutions that couldn't really do what I just said, where the burden of trading and looking after real physical crypto, or not physical, but real crypto, I guess, is a bit too much for them. Even things like family funds, for example, if you're just some small fund that is managing money on behalf of, a handful of high net worths or something, for example, then giving them exposure to Bitcoin without you having to, have a wallet full of everyone else's money, that's really not ideal. So ETFs and similar products in those circumstances for spot Bitcoin, spot Ethereum, whatever else comes down the road, will certainly help those people and those kind of demographics. So yeah, it's a good thing. It's a good thing for crypto. It's a good thing for investors. More choice is never a bad thing. Is AI as big as the internet revolution, Jay? Oh my days, that is that's a question. It seems on the surface like it's not that big a question, but it kind of is. Kind of is. Yeah, and it's a difficult one to answer, honestly. It certainly has the potential to be magnitudes larger, actually, I would say. It has the potential to be magnitudes larger. Really, what that depends upon, though, is, I guess, the continuation of Moore's law and kind of exponential increases in the kind of hardware capabilities to continue to crunch the numbers and improve the models. The software, will also be somewhat limited in how far you can really push it, but the hardware side of things is the true limiting factor. And I think the further you go, and I mean, it's quite concerning, really. I mean, there's, for example, I watched a talk not too long ago from someone that was looking at the potential impact of AI on medicine, and they were looking at potential cures and vaccinations for various diseases and things. And, essentially it was crunching the numbers and, combining different proteins and things to come up with all sorts of different types of potential organisms. And what was interesting was that at first the professor was like, wow, this is amazing. We've been able to go through so many more combinations and possibilities for vaccinations to things than we ever thought, would be possible. It would take us, 10 years to do what it's managed to do in, a few months. But then they did an interesting experiment where they asked it hypothetically to do the opposite and to come up with solutions for creating incredibly deadly viruses and vaccines, viruses and injections, I guess you could say. Not really a vaccine at that point. It was completely different to a vaccine, but looking at ways of combining different organisms to make some sort of a super virus. And the results were horrific. It came back with millions of combinations of horrible, deadly viruses and diseases that could wipe out the entire planet. um, so like any tool, it's all about how you use it, right? And even the internet, I think that's been true for. The internet has been fantastic at connecting people and improving efficiency of business, and it's just been a really good tool generally speaking. But it's also enabled terrorism and money laundering and sex trafficking and all sorts of other things to be made worse. And the same will be true of AI. So there's pros and cons to AI. The potential of AI is hard for anyone really to truly determine. There are plenty of people out there that warn against the dangers of it. People that I agree with, people that I disagree with. But generally speaking, I can completely understand the merits in them being a bit afraid of it. And I am too, to be honest, a little bit. It's very hard to tell where it's going to be in 20 years' time. Very hard to tell. I don't think anyone could really give you a true answer to that. So yes, it does have more potential than the internet. If that answers your question. Maybe it was a bit of a scary answer, I don't know. Sorry if it was, but that's my opinion on it. Absolutely, AI is overhyped. At the same time, as everything I just said, AI can also be overhyped in the short term, and I think that it somewhat is. I think there's plenty of people that think that it's going to solve everything overnight, and in reality, it's still early in the AI journey. Much is stolen. Stephen Fry complained about his voice stolen the other day. Yep, I heard about that. They trained an AI using his all of the audiobooks that he's done, and then used it to create a Stephen Fry voice that they could just use for anything. AI needs to be regulated on a legal and intellectual property aspect. Yep, it's going to be very interesting to see how all of that unfolds. As mentioned, it's one of the good things that I thought that Adobe were doing. I feel like Nvidia is the guy selling the shovels and the gold rush, making all the big money. Yeah, at the moment they are 100%, and TSMC as well. Yeah, and ARM will do well as well, I think, out of it. Do you think banks and economy is still at risk now? Rates are much higher than when SVB happened. I think at this point, most of the risk has kind of filtered its way through the system. Really, like the issue comes for those kind of banks when they're stuck in bad investments, right? They buy too many bonds of a certain duration, and then as market rates improve, they can't sell them to anyone without sacrificing and having no, like there will be no purpose to sell it, right? So, for example, if a bank has a bunch of bonds that they own of some description that are at 2%, and the market rate is now at 3% because interest rates have gone up, and so everyone has access to 3% rates. Even if they wanted to escape that, so that they could reinvest that money to make more money with that money, nobody is going to take it from them because they can go and get 3%. Why would they want to buy a bond that only gets them 2% off of them? So the only way they can sell it then is to sell it at the same as the market rate. So it kind of becomes worthless because they're locked into it. So yeah, I think generally speaking, as a result, the way it tends to work is that when there's a big surprise and when the whole kind of cycle starts, that's the time when banks get caught out. Once the cycle has already started, if they're able to kind of survive and get past those first few months or whatever of it being like that, and start to diversify their portfolio and kind of spread out across the yield curve and into other assets, so that they're able to take advantage of kind of future pricing and readjust everything, then things are a bit more stable. So yeah, I don't think there's too much risk to the financial sector now compared to what there was. Fundamentally, I think it's kind of a demonstration in terms of the explanation I just gave of why, anytime there's a big kind of dramatic shift in yields and rates, the financial sector is at some risk of collapse, especially because it's so entwined these days. I think that's just fundamentally a part of how the financial markets work. It's a bit more difficult to kind of regulate that out unless you really restrict how and where those institutions are investing, and how much they're allowed to invest and how much they have to kind of keep at hand and things. And even then, you can never really protect against everything. It's like just various levels of protection. Um, so yeah, it's a bit of a weird one. I don't know. I don't know if I really answered your question, but there you go. I already answered about Enphase and Canadian solar. Seem confident about solar. What's your thoughts on nuclear? I'm actually really bearish on nuclear. I was neutral on nuclear for a really long time, but the more time that passes, the more bearish I become for two reasons. The first reason is that time is running out in terms of climate change, and nuclear takes a really, really, really long time to build. So the opportunity for us to have started building more nuclear is slowly passing us by. And with the economic environment in the way it is now, I think essentially that ship is more or less sailed. I don't really buy into the whole vision of small modular reactors that much anymore. I never was a massive fan of it in the first place. I honestly think it was mostly kind of hype. But ultimately, like, having one big reactor or having lots of small little reactors, I don't understand the issue it's solving really, apart from niche edge cases for very remote areas that don't have many other options in terms of energy. It doesn't really solve a problem. It actually makes things worse because generally speaking, things are better when done at scale than small. So yeah, I don't really buy into that. Thorium reactors, I still kind of feel like they had a lot of promise, but again, it's taking too long to get the test reactors up, and then to build enough evidence to suggest that this is the way we should be doing things, and then to change all the regulations everywhere, and start building them en masse. We're just running out of time really to go with that option. So really, I think the nuclear market is likely to stay at a somewhat similar size to what it is at the moment, in that they will continue to maintain reactors that currently exist, replace a lot of reactors that are currently existing, but generally speaking, in terms of the new market for the increased demand for power, I think most of that is going to be taken up by solar, wind, tidal in some cases, and even gas and oil and everything else in between, wood pellets. I think all of those are still more likely to kind of get that new business because they can just reach market so much sooner, and fundamentally they're also cheaper at the end of the day. And that's only improving really as well. I'm going to close this out quite soon because as much as these questions have actually been really good and I'm quite enjoying it, I don't want to make it too long after my presentation. So maybe I'll answer, like, if you got any final questions, type them in now and I'll try and get to the end of them. But I think in the next 15 minutes, I want to be kind of wrapping up. Do you plan on holding Enphase for the long term? Yes, I do. And SolarEdge. I plan on holding both of them. I see them as a kind of a package, really, a package deal. You buy both of them and you have full exposure to the market across multiple geographies and two different technology stacks that work in slightly different ways, solving the same issue. So yeah, I see them as kind of a duopoly. Which am I more confident on, Enphase or AMD? I skipped some somehow. I think you guys typed a lot of questions, maybe quickly, or typed a couple and it just kind of shifted up in a way that was very similar. mentioned inverters, but aren't Tesla also creating their own? Tesla's inverters are awful. If you ever have the choice of having a Tesla Tesla inverter, definitely say no. They're terrible. They're basically just standard string inverters, so they don't provide any of the safety features or overcurrent features or regulation of the different voltages at different solar panels that you get with either a SolarEdge style inverter that uses what are they called? Well, it doesn't matter what they're called, little voltage regulator things that go under the panels, or microinverters from Enphase or SunPower or anyone else that makes microinverters. You don't get any of the benefits of them. Your panels will be far less effective. You'll have less control. It will be much less safe. And it will be marginally cheaper, but you'll lose that money in what you're missing out on in terms of features. Not to mention the build quality is dramatically different as well. Which you're more confident on, Enphase or SolarEdge? Currently slightly more leaning towards SolarEdge, but honestly it ebbs and flows between the two. I think SolarEdge is slightly better value at the moment, but generally I like both of them. Remember your early calls on AMD. Do you think your solar bullishness is on a similar level? I do, yes, 100%. And I think it's worth mentioning that, I don't know off the top of my head. Maybe I can try and have a quick look. But I'm pretty sure that the returns, so I started investing in these companies in 2017 for both of them. SolarEdge first, Enphase a little bit later. If I go onto these charts and we kind of measure performance since then. So let's just say, for example, I don't know, mid 2018 is when I invested in them. I'm going to need this on a monthly chart, aren't I, to make this actually usable. Okay. So just for rough demonstration purposes, I've never actually measured to double check, but let's say that I invested in at the start of May of 2018 in Enphase. Oh, I hadn't actually pressed the button then. I need to zoom out more so I can actually see to where we are now. Okay. So even with this massive downtrend, you can see the scale of it there. But if you go back to, I'm still too zoomed in. Okay, here we go. May of 2018, it's back here. And we measure the performance. From then, up until the peak, you're looking at 8,000% return in 5 years from Enphase. And that's the duration, at least, that I was invested in them for. Even if you come all the way down to where the price is now, it's still 3,100% return in about 5 years. So you can see why I'm honestly not too concerned about them having a bad year where they're down by 50%, because I am still essentially up since I started investing in them by over 3,000%, roughly. Obviously, it depends on entries and exits and, the amount of exposure that's ebbed and flowed over time, but you get the picture. And the same is true for SolarEdge. If I check out SolarEdge's chart here, do the same thing. We go to 2018, let's say May. So here's May, start of May until where we are now. Okay, that's only 167%, so not quite so impressive, but I did invest in them quite a bit earlier though. So as I said, possibly an entire year earlier actually, I think, but yeah, 580 odd percent in 5 years. I mean, that's just a ridiculous level of return. How are your cats? My cats are good. A bit scared at the moment because we've got people around doing some work to the house quite a bit at the moment, so they're hiding quite a lot. But apart from that, they're good. I skipped a few questions, so I'm just going to read those and then we're done. Do you think we ever see low interest rates at 1 to 2% as they were a year ago? Well, currently the Fed's predictions that they brought out yesterday or the day before, their kind of roadmap is expecting to get down to 2.2%, I think it was, at the end of 2024, I think. I'm trying to remember the numbers off the top of my head. I think it was the end of 2024 that they're expecting to get down to 2.2% interest in the US. So yeah, it's achievable. How likely is it? I think they're probably being a bit optimistic, honestly, and painting for a best case scenario. So realistically, I'll be content if we get down to 3% or 2.5%, somewhere in that kind of range. But in another year after that, it's entirely feasible. But I think it's too hard to predict that far out. There's so many kind of edge cases and different scenarios and geopolitical events that can affect it. And just normal political events as well, not even geopolitical ones. Have you stopped investing in Trig because of liquidity? Partially, and partially because I think the UK is a bad place to have your money in, and they're generally earning in pounds, even though some of their investments are elsewhere in the EU. I'm not really in favour of holding much in the UK at the moment. I think it's just unattractive. And also, fundamentally, I picked it up and I increased the position size of it ahead of the conflict in Ukraine and the oil and gas thing getting worse as a bit of a safety net. And it carried a bit of a premium through that period, and maybe I should have sold it during that premium and cashed out and made a nice profit. Instead, I cashed out and made a small loss when accounting for the dividends and things. It just wasn't really as worthwhile anymore, sadly. The assets are just kind of in the wrong place, and I think in the environment that we're in and how much markets had dropped, I saw better opportunities elsewhere. I could take that money and put it into SolarEdge now. Putting it into Trig has likely saved me money compared to if I had put it in SolarEdge 2 years ago or a year ago, because they're down in that time frame. But now looking ahead, I think those are likely to yield me a much greater return, and that was fundamentally part of the core reason for why I decided to close those positions. Well spotted though for noticing that I closed them. Most people don't seem to actually comment on the positions I close. Last question. You used to be bullish on CRISPR tech. It's really taken a hit, i.e. Cathy Wood's ETF. Yeah, it certainly has. I still am kind of bullish on it. Part of the reason I never really invested too much into it is because of the risk, and generally that's the same across the kind of medtech space overall, and the kind of the pharma tech space. I think there are just too many things that can cause those companies to absolutely plummet, whether it's a regulator coming out against them or some side effect against a drug, or things like that are really incredibly hard to predict and kind of price into a stock. So that's why I never really liked to invest in them. I still think there's lots and lots of potential there. I still think it's probably worth having some exposure to it for most people. But for me and my portfolio, it's not something that I'm really looking at the moment. Okay, that just about does it. Massive thanks for all of the questions from everyone and comments. I hope it wasn't too boring. Of course, if you want to rewatch it back, if you missed any of it, then you can do so on YouTube once it is up as a video on demand. I really, 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 really hope that my next quarterly update is not as late as this one was, because the last one was late before this as well. And I feel like 2 is a coincidence and 3 is a trend. So I'd rather try and avoid it becoming a trend of me being late on these, because this feels a bit outdated talking about Q2 when we're, basically in the midst of Q3 now, really, about to be. So yeah, I'll try and avoid that. But either way, I appreciate you coming to watch. Thank you for copying if you are, and following. Do check out the articles that I mentioned if you're interested in some of my views, especially on some of the solar stuff that I mentioned. Also, companies like ABB and things, I'm super excited about those as well. Really bullish on them too. But I'll continue to write more things about them. And yeah, I will see you guys next time. Make sure you're following me on the right places on social media as well. I'll just bring it back up again for anyone still here. Okay, that's all for now, guys. Thanks for coming, and I will see you all next time. Bye.